I am in Orlando today, Markets with May. Today, we're going to go through the economic data that just came out, and then we're going to just talk about Best Buy and peace out. Past performance is not indicative of future returns. And I'm going to share my screen, and we're going to go through what it looks like today. 1 second here. Share screen. All right. So when we look at the S&P 500, like we look at the indices, they were up, then they're down, then they're up. I mean, there's not a ton of news flow going into the back part of the year. I am actually going to do a proper review. I'm really close to finished with my 80% of S&P companies. And so we will be able to review which industries did great, which industries didn't. Mostly a lot of them, even if they didn't make the street estimates, which you know how I feel about street estimates, they're insane. I have no idea who is doing these estimates, but nonetheless, it is what it is. But even if they did not make street estimates, a lot of them actually are very profitable, still growing revenues, still growing earnings. But there are some weird things that we're seeing. And with that, I am going to go through the economic data and demonstrate that. But you can see this kind of weird period that we're in where things are up, then things are down, then things are up again. It's strange. Okay, let me show you the economic data then. We had a lot of economic data come out today. This is Thursday. PCE, retail consumer spending, ISM. Please note, though, that ISM and all of the manufacturing and producer related data has been coming out. Every other reporting has been coming out strangely, and that makes sense. That makes sense because we do have regional variation in particular ways. Certain parts of the United States focus on certain types of manufacturing, but the ISM numbers are a little bit broader in the way that S&P manages that report. PCE, however, is the most important thing that the Fed looks at as it relates to inflation. Now, you almost always get some thought process on PCE, so it's almost never a surprise because it comes after CPI. And the way the two are calculated is so smack on top of each other that you would never really anticipate that big of a difference. The street was, or the economists, however you want to think about it, we're expecting 0.5% increase. We came in at 0.3, which is slightly better. Great. Awesome. But we always want to look at what was in the commentary because we are equities folks and we care what is the potential thing that the PCE indicator is telling us about what numbers came in on sales, et cetera, et cetera. And so when we go into the commentary, you can see that 3 areas that really drove the upward movement. First, it was housing. So they divide services and goods because that's what people are paying for on the daily. That's what the PCE is, it's personal consumption expenditures. Now, on the services side, for whatever reason, housing and utilities is there. So rent as a service, in other words, that actually is increasing. We all kind of know that, but it is one of the main drivers right now. Interestingly enough, energy is actually tapering down its massive impact versus last year. And we had talked about the fact that even with an increase in energy prices from here, because you start to go into this weird asymptotic increase that we had last year, you will start to see something strange on that front. Now, utilities still going upwards, still going to have a couple of quarters where you're going to see the utilities bills look higher year over year, but that will start to taper as we get through February and March. Remember, just have a look at the energy chart and then realize that with utilities companies, they absolutely use derivatives contracts to help them out. And so it's going to have a little bit of a lagging impact. Okay. But this right here, I really wanted to highlight because if you look at the names that we've been really bullish on, I will come out with a proper list. But if you look at the names that we are very bullish on, travel is by far one of the areas that we think is completely misunderstood by the marketplace. The marketplace continues to keep the valuations of the travel companies really low because they still have, like, I don't know if it's like some sort of trauma or bad feeling from the 2 years of COVID that drove the airlines into massive debt and the hotels into this crazy corrective state. What I saw on the earnings quarter was nothing short of remarkable as relates to how fast the travel companies are coming out of this trough. And so both international and domestic air transportation was an area for which the PCE showed very strong spending. I suspect that will continue, especially in a place where we have potential railroad strikes and other things. Within goods, again, this is echoed. We're seeing prescription drugs, so healthcare, and that actually is echoed in what some of the healthcare companies that reported talked about, and also motor vehicles and parts. This again, we saw in the CPI number as relates to new car sales. And what I've been saying all along, which is that the used car market, very different from the new car market. Even insurers are saying the same thing. So all this hate talk towards my baby Tesla, that's where it belongs, is in a big fat, actually do your due diligence every now and then and stop it. Okay. Again, it says partially offset by a decrease in gas and other energy goods. We're doing a year-over-year compare. So even though some of you are still probably like, this effing sucks, I spend so much money on gas, this is what we're looking at. Okay, now let's go to the second economic data point that I really want you guys to dig in on, because a lot of times you'll just look at headline numbers and you'll be like, oh, things are awesome. This number actually, ISM came in under 50. So it's a 50, over 50, under 50. So we are seeing slower growth. But when you get into it, it really, we have an earlier episode on PPI that you should absolutely take a look at. We'll make sure to link it at the end of the video. But it really continues to say the same thing that I'm saying, that could be a potential problem. And man, you got to just navigate this like that scene in Star Wars where he's got to get through the Death Star. Because I got to tell you, if these companies talk themselves into a recession, what will happen is that this right here, inventory is declining among the major manufacturers. So the way you read this is this inventory numbers is the primary inventory. So that's going to be like aluminum, steel makers, et cetera. And then customer inventories is the next level up. Electronics components, so they're taking that and turning it into something. And even though those inventories increased a bit, these lower level inventories, if you will, decline. This is not great, because the way that I read this is that the economy is still going like this. And then you've got orders at this level starting to slow. That's feeding into the, let's call it the next level down, folks. So electric equipment, et cetera, where they're actually seeing the ability to get just a touch more inventory. But you'll see that even at these levels, overall, it's still too low as an inventory level, right? But prices are kind of moderating. But if we start to increase GDP growth, or if we get any kind of lift, and it doesn't even have to be in this country, it can be overseas, then inventories are too low. People have not bought, so time will pass and they'll use up what they have in inventory, and we'll be right back where we started, which is a supply issue. So this is not great. The risk is like still under 50%, I'll say, but it's not zero, and it's probably higher than 30. So wherever you want to put odds, that's where I'd put it. This shows up in the ISM numbers. Here are the details on the ISM numbers, so you can really, maybe this wording, some people want more numbers, some people more words, maybe this will help. If you look at the commodities prices, which are down, all of these prices are down, right? So this is aluminum, copper, freight, lumber, all that stuff. This is like all the way down at the very bottom, raw materials, right? That, however, those inventories are waning. So lower inventories, but we're still getting multiple months of downward pressure on the pricing. The stuff in parentheses is the number of months it's been like that. Great. But on the stuff that you then need it for, electrical components, electric and labor, et cetera, that's actually still coming up. So, and then with commodities in short supply, remember this one here, semiconductors, we are very bullish Taiwan semi. There you go. So we have a shortage of these commodities despite downward pressure on the commodity price. That's what's going on. Very awkward. But the net effect is that if we, I mean, you got to drive the bus right down the middle. It's going to be so difficult, but it would definitely not make me think that there's still volatility, and that volatility should be skewed to the upside, not the downside, which might be why we're seeing what we're seeing in the VIX, et cetera. Okay, now let's go into the one company that I am going to talk about. This is Best Buy that reported last week and had really great response from the marketplace. I got to tell you, I don't know. Okay, she's got a really, let me set up Best Buy for you so you understand what's going on here. CEO is this wonderful woman who took hold right into COVID. I think she's really impressive executive. She's got a big vision for what this company is going to be in the future as relates to all these different objectives to make it easier for you to get help with your electronics and be like the help desk, that sort of thing. And also to even use like the metaverse and to see what that object might look like in your place, to see how the connectivity might work. I mean, she's got a really cool vision. She's got to unwind the old business to a place where it makes sense in the new world. And so in that regard, unlike Ross Stores, who I was a little more critical of for what they're doing on their business plan, with her, I'm a little less critical because everything just is an execution of a 2-year plan. That said, this thing rallied like a rock star. And there's one little thing that could be a problem given that we got a railway strike. So that's the context with which I want you to look at this particular set of earnings, or at least that I'm looking at this set of earnings. You look at it however you want. Okay, revenue growth was on the decline. That's fine because I think that was expected even by me, given what CPI was putting out as relates to consumer electronics. Then you can see operating income still not great. Okay, she's getting rid of inventory that probably matters less. New inventory coming in. We kind of knew that would have to happen. This has been part of the 2-year story and so on and so forth. So this is a rally based on the fact that she's executing, not a rally based on the fact that Best Buy is doing awesome. Here's my number one concern for her going into the holidays. If you look at this inventory, merchandise inventory is down year over year. It is really hard to know how to think about that into the holiday season, given that we have a railway strike that potentially is imminent. She even said on the call that the strategy she was taking was, let's see what's going on at the first couple of weeks post-holiday, and then we'll re-up the inventory a bit, and we'll have that second round of refresh on inventories. Oh man, with the railway strike, that one's tough. Now, most companies did see an uptick in inventory year over year. You got to be really careful with the inventory numbers. And quite frankly, I think more than any other year, it's really hard to understand the nature of balance sheet going into the holiday season. Some companies re-upped well, such as TJ Maxx, that took a 30% year over year on inventory, but they've been selling really well. So you can't be like, oh, I don't know. Then you've got Ross Stores that re-upped in contrast 10%, Walmart up 10% on inventory, but both of them had ridiculously low inventory last year, which makes you think that they may be like at, kind of a weird place going into this railway strike. So retail through the end of the year, and especially if this railroad strike happens, regardless of what Congress does, could be really fun for the day traders and certainly very volatile. If you have positions in this, even if it costs you a little bit of money, you may want to start to hedge. Look at puts because that's what you're going to want. You're not going to necessarily want to sell calls because if the railway strike doesn't happen, you just have to cover it as fast as you possibly can. I mean, really, you could do either. But with that, I'm going to stop share and take questions. What's up, David?
Hi, May. Your analysis of the commodities that are in short supply, but they're down in price, right?
Yeah,
Was
so
that
that's a really weird scenario.
Is it a supply side inflation or actual short, excuse oil, but is it a supply side inflation or the actual commodity in short supply?
So it definitely is the commodity itself is in short supply. And in a lot of ways, you got to give the world credit, right? So if you're going to criticize poor Powell for everything under the sun, the idea that monetary policy has a direct impact on demand shows in that portion of what's going on. The problem that he's got is food and energy is a different animal. But basically, demand has tapered enough to where it's decreased, even with the short supply that we have. It's allowed for some price mitigation within raw materials. The only challenge is that price mitigation is coming from people winding down inventory, not from it being some kind of parallel situation. That's why. So for example, prices are going down because the housing market is no longer trying to build up inventory because they're worried that they have to overbuild. And he talks about this, by the way, at the Brookings Institute. So instead, they're just like, we're going to run down inventory. We'd rather be in cash than have raw materials. Okay. Well, it turns out that gives the raw materials guys a little bit of a breath to try to re-up their inventory, which you can see from the PCE number is way too low. Okay. But is it enough of a breath? Big question mark. because we do have the $1 trillion spend coming in. If we can get any kind of movement on Russia and that situation resolving, then the first thing that those countries are going to need to do is go into quantitative easing and really helping the rebuild the entirety of what's been happening in this austere period. I mean, this is going to be like a time, I don't know. Let me stop. Did that make sense the way I said it?
Well, yeah, I mean,
It's
the
on a
economy's
dime
strong.
right now.
What?
This is on a dime. This is basically the equivalent of a teenager driving a car with no gas in it and hoping that they can make it to the next gas station. That's what this looks
Oh, yeah, I've been there.
like. It's not even teenagers sometimes.
Anyway, but if it's in such short supply, I mean, because the economy's really strong, are you saying building materials?
All materials. So if you go back to it, it's actually everything from semiconductors to steel to like the actual lumber, PCE, plastic, all that stuff, short supply. That said, inventories are coming in from the supplier's perspective. So they've already sold through any like they haven't re-upped yet. So at the raw materials level, we have short supply. Next level up, because the level above them is decreasing inventory out of concern that the entire economies of the world are going to collapse. So this top level is going really low inventory. This middle level is trying to figure out some happy medium, knowing that the level below them has no inventory. So it's a really funky situation we have, the three different areas. So usually you can read the headline number, but this time you can't, because the three different layers that the numbers come out on. The end layer, which is that actual manufacturing line, the business community, before they sell it to consumer, they running down inventory because they're worried. Then the middle one, the intermediates, which is what was shown in the PPI numbers that we talked about last week or 2 weeks ago, that middle layer actually has inventory for the first time, but they're freaked out because they can look down at the bottom layer and see that there's no inventory. So that's what's happening right now. It is on a dime what will happen. Is that,
So you're saying if I just don't get it, the economy's strong. You're saying if it gets stronger in the first quarter, those inventories will be in short supply, which would mean prices would be higher. Right?
And also we'll still have a supply constrained issue for time to come, which puts the Fed in an awkward spot. But in fairness, this isn't their fault. This is a fiscal policy issue as much as anything else.
Got it. Okay.
The major fiscal policy issue that it is, let me be crystal clear. And I've said this since 2 years, since the very beginning. As much as like, I can never really be fully in on any political party because each one of them says something stupid. And one of the stupidest things that the Republicans say, for all the positive things they say, is their stance on immigration. We are not going to be able to, given what the data says, be able to get through this through birth rate. We're going to, I mean, first of all, it takes like 15 years for that, 18 years for that person to even enter the job market, 15 if they're entering the low end of the job market, right? Second of all, those kids don't want to do what it is we need them to do. So the major way you could allow this to work out is stop deporting H-1Bs and like also let people into the country at a different rate than we're letting them in at. If we did that, that would actually take a lot of pressure off of the labor market. And if you're confused about that, one day I'll do a series of clips that I think are relevant on what was said at the Brookings Institute, but we just don't have participation increasing despite the fact that a lot of those helicopter money, all those checks are done at this point.
Okay. High five on Salesforce.
Oh my God. There's just so much still coming. It's such a weird market right now, isn't it? Like,
well, I mean, you were bearish on them and they've fallen apart. Salesforce.
I mean, I wish I'd held my shorts at a bigger position. I would, it's really tough. You gotta have infinite money sometimes in this marketplace, but yeah. Whoops.
Okay.
All right, guys.
Thank you.
Take care. Bye. See you tomorrow.